This is Dinar Shift, and we're diving deep into a financial development that has currency holders and global market observers utterly captivated. The world of foreign exchange is rarely known for seismic, overnight shifts, yet we are witnessing one right now, involving two currencies that traditionally sat outside the spotlight of major international trading: the Vietnamese Dong, VND, and the Iraqi Dinar, IQD. The reports coming in are nothing short of astonishing. Picture this: the Vietnamese Dong suddenly commanding a valuation of $4.09 per unit, and the Iraqi Dinar surging to $4.18 per unit. These figures represent a monumental increase in perceived value, potentially reshaping the fortunes of long-term holders and challenging deeply entrenched assumptions about the potential of emerging market currencies. This is a story of global capital seeking new frontiers where patience may finally be meeting unprecedented opportunity. For many years, both the VND and the IQD were largely relegated to the fringes of global finance. They were seen as local instruments, primarily serving domestic economies in Southeast Asia and the Middle East, respectively. The Dong was often described as a managed or loosely pegged currency, appreciated for its relative stability within Vietnam but offering little in the way of dramatic upside for international speculation. The dinar, conversely, was widely associated with high-risk, political uncertainties and Iraq dependence on oil markets, and the lingering shadow of past sanctions. Mainstream global investors consistently overlooked both, labeling them either too benign for meaningful gains or too volatile for serious long-term investment. This quiet obscurity, however, may have been the calm before a spectacular storm, allowing underlying economic realities to build pressure unnoticed. The sudden dramatic movement in these exchange rates suggests a profound and likely multifaceted shift is unfolding beneath the surface of the global economy. It implies that the forces dictating capital allocation are seeking opportunities in previously ignored territories. What does a valuation of $4.09 for the Vietnamese Dong actually signify? For decades, the Dong's value was not known for spectacular moves, trading at fractions of a cent against major global currencies. A jump to over $4 per unit is a powerful signal of entirely new market sentiment. It reflects dramatically increased international confidence in Vietnam's robust and expanding economy, its stability, and its long-term growth trajectory, driven by booming manufacturing and export sectors. This development shifts the Dong from being merely a unit of local exchange to suddenly becoming a globally recognized, highly leveraged asset. Turning our attention to the Iraqi Dinar, the reported $4.18 valuation is perhaps even more eye-opening, given the currency's historical narrative. The IQD has carried the burden of its nation's history, struggling against the backdrop of political friction, oil price volatility, and global skepticism regarding its monetary policy. For the dinar to break past the $4 mark suggests a radical reevaluation by the market. It fundamentally questions the long-held perception that the Iraqi currency was too speculative or fraught with peril to be considered a viable asset. This potential change in valuation implies a renewed sense of economic and political stabilization within Iraq, suggesting that significant structural and economic improvements are being recognized and priced in by global exchanges. The confluence of these two distinct currencies experiencing such a synchronized, monumental surge points to broader trends in global capital migration. Why is this happening now? One key factor is the widespread search for yield outside of traditional financial strongholds. As major world economies grapple with issues like inflation and varying dollar volatility, investors are actively seeking emerging economies that offer both strong growth fundamentals and the potential for a currency revaluation event. Vietnam and Iraq, each for their own unique reasons, appear to be hitting that sweet spot at the moment. This search for diversification and higher potential returns is aggressively driving demand into non-traditional currency markets. Furthermore, a significant element fueling this momentum is the potential for renewed confidence in the underlying economic foundations of both nations. In Vietnam's case, years of consistent foreign direct investment, strategic export growth, and infrastructural development seem to have reached a critical mass. The economy is seen as resilient and integrated into global supply chains. For Iraq, the narrative is perhaps tied to improved political stability and more effective management of its vast hydrocarbon wealth, which could be translating into a higher level of economic predictability and, crucially, a stronger fiscal outlook that supports a revalued currency. These positive shifts are what institutional and sophisticated capital look for when making significant moves. A third force at play is the growing global appetite for diversification away from reserve currencies. Weariness over persistent high inflation in major economies and the fluctuating value of the US dollar is prompting a broader look at alternative assets. Non-traditional currencies, especially those with perceived undervaluation and strong growth potential, become attractive targets. When these macro factors align, global capital searching for returns, demonstrable local economic improvements, and a drive for currency diversification, the resultant demand can exert immense upward pressure on exchange rates. The VND and IQD may simply be positioned perfectly to benefit from this confluence of international monetary currents, proving to be the right currencies at a very opportune moment in time. For individuals who have quietly held on to these currencies over the long term, this sudden surge could understandably feel like a dramatic financial turning point. Those who acquired Dinar or Dong years ago, perhaps when they traded at deeply suppressed rates, and exercised the discipline of patience, may be looking at gains far exceeding any initial expectation. This is the moment where latent financial capital can potentially convert into significant, realized wealth. The duration of their conviction is now being tested as the market validates their belief in the future potential of these economies. Beyond the realm of long-term holders, this revaluation has major implications for the diaspora and expatriate communities connected to Vietnam and Iraq. For individuals who regularly remit funds back home or have saved in their native currency, converting their Dong or Dinar into a stronger hard currency or leveraging the funds back home could result in a substantial financial windfall. The increased purchasing power on the ground can have a life-changing impact, enabling everything from paying off debts to funding education or securing property, fundamentally altering the economic stability of entire families and local communities. For market participants focused on momentum and speculation, this event represents a rare and powerful play. A rapid, high-magnitude currency movement naturally draws the attention of those looking to ride the wave of appreciation before it culminates. However, this potential for gain is inextricably linked to pressure and the inherent challenge of market timing. It's no longer just about the currency reaching a new high, it's about the crucial subsequent decision of what to do with that elevated asset, a moment where calculation must decisively outweigh excitement. The potential for sudden shifts necessitates a cool-headed approach to capital management. However, it is essential to contextualize this dramatic upswing with a sober assessment of the risks involved. Any significant, rapid spike in asset value is typically accompanied by a corresponding increase in volatility. What experiences a swift rise can, without warning, endure an equally abrupt and sharp correction. Market sentiment is notoriously fickle, and factors entirely external to the currency's intrinsic value, such as sudden political friction, unexpected regulatory changes, or a shift in major global economic policy, could rapidly reverse substantial gains. The specter of unpredictability must always temper any enthusiasm for quick appreciation. Another critical consideration for those holding these revalued currencies is the issue of liquidity. While a currency might possess a high theoretical exchange rate on paper, the practical challenges of converting a large volume of dinar or dong into a universally accepted hard currency can be significant, especially in emerging or frontier markets. Liquidity can dry up suddenly, capital controls or bureaucratic red tape can emerge, or simply a lack of immediate buyers at the new rate can make actual, real-world conversion difficult or costly. If the surge is driven disproportionately by speculative momentum or hype rather than solid, sustained economic fundamentals, its longevity and ease of conversion remain highly questionable. The effects of this massive currency revaluation extend far beyond the direct currency holders. They send ripples through the entire international economic system, influencing global trade, investment flows, and regional competitiveness. For Vietnam, a manufacturing and export powerhouse, a significantly stronger dong could make its goods more expensive on the global market, potentially slowing its export engine. Conversely, imports become cheaper, altering the nation's overall trade balance and potentially influencing domestic inflation. For Iraq, an oil-rich nation, the stronger dinar complicates the economics of oil pricing and the subsequent management of its national revenues, as the value of the converted petrodollars shifts. On the international investment stage, currencies like the VND and IQD are immediately elevated in status. They move from being obscure or speculative instruments to potential new frontier market plays. This reclassification could trigger a massive influx of attention from global institutional money, including emerging market funds and global bond traders, who previously ignored these markets. This shift necessitates a revision of global asset diversification strategies, as new options with proven volatility and potential emerge. This is not merely about a few individual success stories, it's about altering the fundamental perception of regional economies on a worldwide scale. Identifying the source of this buying pressure is crucial. The surge is likely being fueled by a complex mix of participants, This includes regional investors spotting what they believe to be undervalued assets, a growing number of diaspora members remitting and converting funds at more favorable rates, and, of course, speculators betting heavily on the revaluation event. It also involves the patient, long-term believers who have held through years of stagnation. Crucially, the possibility remains that a large, institutional fund or a collection of major players recognized the gathering momentum and began quiet accumulation, thereby excel. Rating the demand and fueling a powerful, self-reinforcing feedback loop. Whatever the precise composition of the buyers, the key takeaway is that this is no longer a localized whisper among a small community of enthusiasts. It has morphed into a global event, gaining volume with every tick of the exchange rate. When substantial global capital decides to move, the speed at which smaller market currencies like the VND and IQD can be jolted to dramatically higher valuations is breathtaking. This is the power of coordinated, or even just parallel conviction, across disparate geographical and financial market segments, a testament to the interconnectedness of modern finance. Given this backdrop of dramatic movement and market reevaluation, the natural question arises, is this the moment to engage with these currencies? For those with a fundamental belief in the long-term economic trajectories of Vietnam and Iraq, and a willingness to commit to a sustained patient hold, the opportunity may seem compelling. However, for anyone chasing a fleeting get-rich-quick narrative driven solely by the recent price spike, disappointment and significant capital loss are palpable risks. A prudent approach demands a long-term perspective, acknowledging that the most sustainable wealth is typically built over time, not overnight. A balanced strategy, particularly for long-term holders who are now in profit, often involves diversification and strategic partial conversion. This could mean taking a portion of the realized gains and converting them into hard, stable assets such as real estate, precious metals, or established reserve currencies, effectively locking in some profit and mitigating risk. The remaining portion could then be held as a speculative position to ride any further upward momentum. The cornerstone of this strategy is balance, avoiding the emotional pitfall of going all in based on sheer excitement or fear of missing out. Logic must remain the primary driver of all capital decisions. Above all, a fundamental requirement in a market experiencing such high volatility is the commitment to staying comprehensively informed. This involves continuous monitoring of official currency exchange platforms, closely analyzing communications from the central banks of Vietnam and Iraq, and diligently tracking global economic and regional political headlines. It means watching for any news pertaining to economic reforms, major trade agreements, export data, and any explicit central bank statements that could signal policy changes. In a fast-moving scenario, being early and well-informed is the strongest defense against risk and the greatest amplifier of opportunity. Moreover, the influence of global commodity prices, especially for oil, metals, and key manufacturing inputs, cannot be overstated, as they often significantly affect the currencies of emerging commodity-driven economies. Monitoring global interest rates and inflationary pressures is also paramount, as these macro factors directly influence global capital flows and risk appetite. When a massive and volatile currency swing is underway, the market environment is fluid and things can change almost instantaneously. Diligence and foresight are the only reliable tools for navigating such dramatic market episodes. On a practical level, securing potential gains requires proactive and calculated steps. If a decision is made to hold the currency, ensuring that it is stored securely and through reputable channels is critical. Avoiding non-regulated platforms or exchanges with poor liquidity is non-negotiable. If the decision is to convert, performing transactions through official, trustworthy exchanges is essential. Furthermore, it is important to be aware of the often complex layers of fee, taxes, and government regulations that may apply to large currency transactions, particularly in emerging markets where oversight can be complex. A key aspect of responsible financial management is the meticulous documentation of all currency purchases and conversions. Comprehensive records of acquisition and liquidation may be necessary for future tax reporting, especially in the event of substantial profit. Crucially, all actions must be insulated from the raw emotion of the market. Greed and fear are often misleading indicators. Treating this moment as a calculated strategic move, backed by research, rather than a mere gamble, is the only way to safeguard capital and ensure that paper gains convert into real, usable wealth. It is important to maintain realistic expectations for the near to medium term. While a price surge of this magnitude is undeniably exciting and can deliver huge returns to those who are positioned early, sustainable, multi-year growth requires genuine, long-term economic strength. This foundation must include stable and consistent government policies, a continuous influx of foreign investment, healthy trade balances, and, most importantly, sustained investor confidence built on predictability. The long-term performance of VND and IQD will ultimately hinge on the robustness and persistence of these underlying fundamentals, which are always subject to correction and periodic dips, even after major surges. For those observing this massive shift from other developing nations, this moment offers profound, broader lessons in global finance. It serves as a powerful reminder that currencies previously dismissed as structurally weak or overly uncertain possess a latent potential for dramatic revaluation. It powerfully underscores the strategic value of true diversification, not just across different asset classes, but across diverse geographical markets and non-traditional currencies. It highlights how the flow of global capital is capable of affecting even the most distant and insulated markets, reshaping them in unexpected ways. Most importantly, this event is a testament to the value of patience, meticulous research, and an informed long-term strategy, proving that these foundational principles can often yield superior results compared to chasing mere hype or short-term speculation. For individuals open-minded enough to learn the lessons unfolding right now, this could be an essential wake-up call, prompting a fundamental reevaluation of how they manage their investments, both in local and foreign currencies and where they seek future capital appreciation opportunities. For families, migrants, and communities reliant on remittances, the implications of this currency shift are potentially transformative and life-altering. The prospect of receiving a money transfer from abroad where the home currency is worth dramatically more translates directly into substantially greater purchasing power back home. This new reality could provide unprecedented financial breathing room, settling debts, affording higher education, or facilitating property ownership. This requires careful, non-rushed decision-making about the optimal moment to convert funds, the amount to exchange, and the wisest avenues for long-term investment or safe storage of the newly gained capital. For anyone contemplating entering the market at this elevated stage to acquire VND or IQD, a deep, honest assessment of personal financial goals is crucial. Are the motives centered on attempting to capture a fleeting, short-term gain? If so, the strategy must be hyper-vigilant, involving constant market monitoring, the setting of strict stop-loss points, and a predetermined exit plan for taking profits. Or is the intent a long-term commitment based on a genuine belief in the future structural growth and economic reforms of Vietnam and Iraq? In that case, the asset should be treated as a long-term hold, with a significant portion perhaps converted and reinvested into other diversified, stable assets. The necessity of diversification cannot be overstated. It is the most reliable hedge against the inherent uncertainty of a concentrated currency position. Never commit all available capital to a single currency or a solitary asset class. Furthermore, the volatility of liquidity remains a central concern. While current demand might be high, ensuring an easy and profitable exit remains the final and perhaps most challenging test. If global sentiment were to suddenly reverse or if large institutional holders decided to liquidate their positions, exchange rates could plunge, making the actual conversion of paper gains unprofitable or outright difficult. Every investor must ask, if I needed to convert a substantial amount today, could I do so easily and at the reported rate? As we bring this analysis to a close, the immediate actions for all involved should be clear. First, commit to rigorous and continuous due diligence, regularly checking official central bank announcements, monitoring exchange rates across multiple reputable platforms, and consuming all relevant economic news from Vietnam and Iraq. Second, clearly define your personal risk tolerance. Only commit capital that you are genuinely prepared to lose entirely. Third, implement an advanced strategy. Predetermining the precise portions to hold, convert, or reinvest is critical. Finally, and most importantly, resist the impulse to follow market hype. All moves must be grounded in cool, rational logic, not the intoxicating rush of emotion. The dramatic surge of the Vietnamese Dong to $4.09 and the Iraqi Dinar to $4.18 is far more than a simple numerical chang. It is a powerful signal of a potential profound realignment in global currency dynamics, one that challenges long-standing assumptions about the potential of emerging market economies. This shift offers a dual reality, immense opportunity for those with foresight and patience, but also significant hazard for those who move blindly. Approaching this with a thoughtful combination of caution, information, and strategic patience is the only way to maximize the chances of emerging ahead. Rushing in without a plan is a direct invitation to be caught in a wave that can recede as quickly as it rose. The undeniable bottom line here is a call to intellectual rigor in a time of market frenzy. Be informed, remain cautious, stay strategic, track the underlying economic and political trends, and absolutely refuse to be drawn in by the overwhelming noise of market hype. If a decision to invest or convert is made, it must be executed with wide-open eyes and a carefully calculated strategy. The upswing in both the VND and IQD is real and has captured the world's attention, spanning continents. However, in the unpredictable world of international currency, today's unprecedented winners can quickly become tomorrow's stark, cautionary tales. Clarity and calculation, not panic, are your most valuable assets right now.